It's my pleasure to introduce Lorenzo van der Veren, who is a fund manager from De Groef Petercam Asset Management, so DPAM, and we're going to hear about energy transition, how you guys are doing it at De Groef and how you're doing it as a fund manager. So
exactly.
Please,
it working?
It works, yeah. Please feel free.
Good afternoon, everyone. My name is Lorenzo van der Veren. I'm a fund manager at DPAM Industries. I'm very pleased to be here today to discuss transition investing and how we see that at DPAM. This is the agenda for the next half hour. And it's always good to start with the why question, why transition investing? And we will begin with a definition, how we see transition investing at DPAM. We believe at DPAM that transition investing should focus on financing companies and industries that play a crucial role in the orderly transition towards a low-carbon economy. And that encompasses basically three types of companies. Firstly, the high-emitting companies that have credible transition strategies. Then you have the solution providers, the enablers. And finally, the companies enhancing resilience and adaptations to climate risk. Now, I must confess, I'm a value fund manager, so I'm mostly focused on the former part, and that's going to be the topic of the next half hour. So we believe that transition strategies offer a credible balance between sustainable strategies on the one hand and mainstream strategies. Because when we think about sustainable strategies, as it has been done in the past at least, they often exclude high emission sectors, and therefore they miss a little bit the opportunity to drive change. On the other side of the spectrum, you have mainstream strategies that clearly overlook ESG risks, such as risk of stranded assets or risk of failed decarbonization. And right in the middle, you have transition strategies that offer maybe a more pragmatic approach and that can have an impact in the transformation of hard-to-abate industries. We see three main benefits to transition investing. The first one is about performance because it helps capture the upside from transitioning companies to that low-carbon economy. In terms of impact, you also have real-world impact with companies putting CapEx on the ground to decarbonize their operations. And finally, in terms of risk management, as was said in the previous presentation, well, it's about anticipating regulation, carbon pricing, but also climate risk that is much better managed with transition strategies than with mainstream strategies, for example. And in the meantime, we see that over the last 3 years, among ESG strategies, transition strategies are gaining traction, and that's driven by both political impetus and common sense. Now, let's move on to the regulatory landscape of transition investing in Europe. We see two key pillars for active investors, active European investors. The first one is the ESMA fund name guidance that has been enacted, and that requires funds with a transition in the name to be 80% invested in compliance with the ESG characteristics that apply climate transition benchmark exclusion, and that track KPIs in order to see if decarbonization is happening at the investee level. And then we will have the review of SFDR, RTS level 2. It was supposed to be for 25, but it's probably going to be for 26, early 26, hopefully. And here we will probably move from a categorization system with Article 6, 8, 9 to hopefully a label system with transition category, which should improve the momentum of transition investing. 2 years ago, the European Commission unveiled the Sustainable Finance Framework, where it says that transition investing is about financing companies and having portfolio aligned with the different elements here. So it's about keeping the climate transition benchmark exclusions or Paris-aligned benchmark exclusions, or it's about having a high proportion of taxonomy-aligned activities, financing taxonomy-aligned activities. It's about financing companies that offer a credible transition plan, or about companies having credible science-based targets. Now, the coming slides, I'm gonna show you what we do and how we do it at DPAM. But fundamentally speaking, we are fully aligned with the last two slides that we've seen. So what's our secret sauce? We always start with the investee level. With, of course, the objective which remains the same, declining carbon emission years after years, not on a it can be a bumpy road, of course, but that remains the goal that we have. But we need to look at investee from different perspectives, because you have moving elements. The company might already be aligned, it might be aligning, or it might not be aligned at all. That shouldn't prevent us from engaging with those companies. The company might be transitioning, might already have transitioned, or it might be an enabler. So you have different perspective. Now, the next step is about climate alignment and transition alignment. So on climate alignment, what we want to ensure is that we analyze the greenhouse gas emission path of the company, and we include more and more scope 4, despite the lack of information sometimes, but it adds real value in our analysis. We look, of course, at science-based targets. We look at the different decarbonization levers that the company has. And of course, the speed of the transition also matter. And for that, we use what we call the taxonomy-aligned CapEx as percent of sales and the evolution of this CapEx as percentage of sales through the years. So that's to see if the company is indeed decarbonizing its operations, and that is good, but it's not good enough. What we want is a company that only is able to decarbonize, but to decarbonize in a fashion that is creating value for shareholders. And also managing other risks, other physical risks. And therefore, we try to assess the achievability of the targets, medium-term targets, long-term targets, with current technology, future technology. We try to have an opinion on the free cash flow impact of this decarbonization. You will see that many times there is a lot of big amounts of CapEx involved. Does it make sense for the climate to put this CapEx on the ground? Probably yes. Does it make sense does it make economical sense to put this CapEx on the ground? That is another question, and why we want to ensure that both aspects are met. It's not only about CapEx, it's also, through the whole P&L of the company. You can have green premium, you can have higher OPEX or lower OPEX. So those kind of things, we try to integrate them in our analysis. And also, of course, we have a look at company reporting that maybe sometimes a bit lacking on scenario analysis and the perception of physical risk that they have. But that is something that we look at the investee level. The key takeaway here is that we have that double materiality. It's a focus on the ability of the company to achieve their decarbonization targets, but in a sustainable way for the company, which is by generating still cash flow and profits to remunerate adequately the risk taken by shareholders. Now we take a step back from the investee level, and we try to assess the supply chain, the value chain, as well as the regulatory landscape, which of course have a big influence on the ability of the company to decarbonize. So at the sector level, as I said, we look at the different technologies available. When we discuss with the company, we realize very often that medium-term targets are achievable with current technologies at a decent cost. But that to reach a net zero emission footprint, then you need the creation of ecosystem of technology that already exists today, but that are either not at scale or not affordable, such as green hydrogen. We also try to analyze the sensitivity of customers to pricing. Are they ready to pay for a premium for greener products or not? Because obviously decarbonization has a cost. The cost will be borne by society, by clients, and sometimes by the governments if they need to subsidize some of the activities. But all this is very important, of course, for the decarbonization of the investees. Then on the policy and regulation side, it is not only about carbon regulation, but of course it matters a lot. It's an holistic view on regulation, to what extent, and here it's not only about European regulation, it's about regulation in different countries. We see that in Europe we are still moving forward, maybe at a lower pace, but we see that in other geographies they are moving backward, and that of course impacts our companies, our European companies that operate in other geographies. We also try to analyze if there is some fiscal headroom to help companies decarbonize. That is very much on a country per country basis. Clearly, Germany or the Nordics, they have more budget headroom than France or Spain, to give some examples. And that matters, of course. Now, what's in the toolbox at DPAM? What do we do concretely? The first step is always about the ESG screening. That is fairly basic, to be honest. It's the normative screening, removing all the companies uncompliant with the Global Compact. It's about negative screening, so removing some controversial activities. For example, coal. We believe indeed that coal doesn't have its place in the transition debate. There are the examples. And it's about the positive screening, so that means removing the worst-in-class management teams of the universe. So that's the first screening, and that is the first step. Then what we do with the remaining companies, and here exclusively with the companies we have in our portfolios and with the companies we have interest in investing in, is what we call the TCFD assessments. So that's a deep dive, fundamental analysis of their transition strategy. And as I said before, it's about assessing the credibility and the viability of those strategies. Does it make sense for those companies to transition, and can they do it on a way that is creating value, or at least preserving value for shareholders? So here we have two types of engagement. Can be formal engagement, when actually we see that the company has an ambitious targets or no targets at all. Then we try to push formally for them to put science-based targets. And sometimes they tell us that they are unable to get SBTi validation because there is no framework available for that specific industry. That's, for example, the case of the automotive industry. If that's the case, we can of course understand that, but we want to ensure that the company is taking investment decisions to allow for a low carbon economy in the future. So to what extent are they still betting on ICE, or are they moving towards EVs, even though they still build ICE to generate the cash flow needed to finance the transition? Something we also look at is the lobby. In Europe, for example, we see that 2035 regulation on ICE vehicle will probably be scaled down, probably. That is a matter of fact, and the companies, you can have good pupils that are in that situation, and should not be negatively impacted by something external such as that. But if we see that on the back seat they have heavily lobbied to have those regulation being scaled down, then of course that's something that we need to consider. So the purpose of that TCFD assessment is to is to find a risk-return, risk-reward balance of the transition of every investee. On the engagement side, that is a step that goes hand in hand with the TCFD assessment. So, as I said, it's about engaging either formally or informally with the companies to understand better their decarbonization levers, if they have the technology available now or not, and so that we can make an opinion on the achievability of the decarbonization. And finally, we use regulation as a value creation, understanding the regulation and the impact, the risk and opportunities of regulation on the business models of the companies we invest in. But that's, of course, it's quite a time-consuming part. But for example, we see that on the European side, the steel sector now benefits from, well, should benefit in the coming months once it's enacted, from improved safeguards that will help the steel industry in Europe maybe to generate higher margins, more cash flow, and to be able to invest in a transition. So we see that positively. At the end of the day, what we want, what we aim at is to accompany our investees in their decarbonization journey, to build sustainable and future-proof business models for a net zero or for a low carbon economy. And by being the leaders in their own industries, creating the competitive advantages that actually should warrant higher valuation multiples, all else being equal. So at the end of the day, we should end up with companies doing good for the climate and at the same time doing good for shareholder returns. Of course, that is it was very easy to say, but it's complicated to implement. There are many pitfalls and challenges. I would say the first one is the regulatory uncertainty. As I said just a couple of minutes ago, how the United States is going backward. That's unhelpful for investment decision of our investees. We see also that in Europe, the regulatory landscape is not clear, unfortunately. We have divergence between countries, between geographies in the globe. That is, of course, not helpful. Geopolitics and sovereignty aspects add a new layer of complexity. And that impact, of course, the sourcing of raw material for our investee companies can be quite damaging. As an example, now apparently China wants to reduce a little bit or to curb the supply of cathode material, anode material, and batteries for EVs, the export to Europe and overseas. Well, that will, of course, have a negative impact on the ability of European automakers to decarbonize. That's a matter of fact. Manufacturing overcapacity in some regions of the world also have a very detrimental impact on the ability of the companies to decarbonize. If you face unfair competition, you don't make enough returns, you don't generate enough cash, and that means that you are not able to invest in new plants to decarbonize. Market dynamics and the willingness of customers to adapt, to maybe pay for that green premium, because at the end of the day, that is what will happen if we want to decarbonize our societies. Supply chain I've already discussed. Technological roadmap is a bit the same. So it's many of the long-term targets of the high-emitting companies. It's about CCUS, it's about green hydrogen, etc. We can talk. It's a very nice discussion, but as long as you don't have the ecosystem in place, the net zero economy will not happen anywhere in the world. Interest rates environment is also very important. When the cost of money is cheap, then you can easily finance capex and projects. The required level of return is lower. Now that we are in a different interest rate environment, that hinders, of course, capex. And finally, we discussed that a little bit in the previous presentation, some kind of investor fatigue on sustainability trends. We can have different arguments, but it's true that the returns of the last couple of years has been a bit weak, and maybe it's not because of clearly ESG characteristics, but maybe more about the normalization of the interest rates environment, where ESG funds maybe tend to be more quality growth funds have been negatively impacted. That's another debate. I don't want to enter that. But you see that there are many pitfalls and challenges. Now I still have 10 minutes. I'm going to give you some examples of companies and how they face the transition, how they manage it in 3 different sectors. The first one is SSAB. Among materials, it's a steel maker with operations in the Nordics, Sweden and Finland, and also in the United States. Well, we see that's for us a good example of a company having a good grasp of its transition, at least on a scope 1 and 2 basis, thanks to regulation, protectionism, as I said, in Europe, and thanks to abundant renewable power. To decarbonize the steel sector, of course, in Europe, so it's based on mostly on blast furnaces, the carbon steel sector. You need to switch that, to invest in new capacities, electric arc furnaces that run on power, and then of course to run them and to have a low carbon footprint, you need renewable power. You need a lot of renewable power, and that's what they have in the Nordics. Unfortunately, you don't have that in Germany. So here, SSAB has a competitive advantage versus other steel makers in Europe to decarbonize. On the scope 3 reduction, to be honest, we have more doubts, and that's going to be, so there's scope 3, it's mostly upstream supply of raw materials, iron ore, etc. They don't have a grasp on that. They engage with their suppliers, but of course, we want to understand a little bit better how they will manage the decarbonization of scope 3. That's going to be the subject of our engagement with them in the coming weeks. To decarbonize their scope 1, the company faces significant investments in the Nordics, and that has spooked investors. That's where we found the valuation opportunity. We believe that those decarbonization makes, of course, a lot of sense for the climate, but also for shareholders, because it's not only about decarbonizing, it's also about improving meaningfully the efficiency and the operations of the steelmaking business in the Nordics. Meaning that after those investments, they will be able to generate higher margins, higher returns, and therefore that should warrant a higher valuation premium, we believe. And of course, with a clean footprint, they will not face the rising cost of carbon unlike their peers. So that's a key competitive advantage. In the meantime, I've already discussed the EU steel safeguards, how that will help improve their earnings. And so that's a bone for profits and returns. So all in all, we see that SSAB is able to deliver on the transition on a way that is value creative for shareholders. Now, another example, which is more complex, is Daimler Trucks among industrial. That's a truck manufacturer with a presence in the United States, in Europe, in Brazil, and in Asia. And they face a more challenging decarbonization journey. To decarbonize freight transport, you need, first and foremost, product availability at a reasonable total cost of ownership for the clients. If the truck is way too expensive, the clients will not buy it. So that is the responsibility of Daimler Trucks to come with the availability and the reasonable cost of purchasing and operating the truck for the client. But that's not the only lever to decarbonize freight transport. You also need infrastructure. That means the EV charging network. And you also need supportive regulations. That depends on politicians and society. So our view on Daimler Trucks decarbonization is that they have a smart approach For the moment, they have a flexible and modular production plant, meaning that they can build a diesel truck, and in the same day they can build an EV truck, a battery electric battery truck. They can already do that today, and also they do partnerships to reduce risk and capex, big investments when it comes to hydrogen, for example. So they have a smart decarbonization strategy, but we see that first, clearly, the charging network is suboptimal in Europe and in the United States. And on top, in the United States, the government is going backwards on the legislation on CO2 emissions and NOx emissions. That is clearly unhelpful for Daimler Trucks. So, and as a consequence of that, that's a slide of their CMD in July 25. As a consequence of that, they are scaling down the investments in EV trucks and in hydrogen trucks, and they are increasing a little bit the investments in diesel trucks. That is something that is not happening in Europe. That is clearly unhelpful for their decarbonization strategy. How do we assess that? It's a little bit tricky from our side. Well, what we like is that the management remains pragmatic, and we believe that Daimler Trucks, maybe not this year, maybe not next year, but they will remain a credible actor in the decarbonization of freight transportation in the globe. So we like the fact that the company is pragmatic, working on margin improvement, on execution, on returns, capital allocation, and on the fact to bring the right product at the right time. So we keep that company, even though we know that it is a bit hindered by the environment. The last example I have is Total Energies among energy companies. So it's a oil and gas company that faces the delicate energy quadrilemma equation. So that means providing energy that is available, affordable, decarbonized, and sovereign. We see that Total Energies among European oil major is the most credible actor and manage the best this quadrilemma equation. They have a decarbonization strategy that makes financial sense. Of course, it is not perfect. It remains an energy company. Let's be clear. But they do have net zero targets. They are reducing sales of oil, so that helps them in the short term reduce their carbon emissions. Of course, they are just selling the retail network. So someone is buying that. So for the planet, it doesn't change anything. Let's be fair. They keep on investing substantially in gas that we see at DPAM as a transition energy. I know that there is a debate around gas as a transition energy. We believe that it will be helpful to decarbonize power production in Asia. And first and foremost, they also have a credible integrated power strategy. So they invest massively in renewable power on a smart way, unlike some peers. And thanks to that, they can achieve double-digit returns, which, of course, is important for us. They will be, by the end of the decade, one of the biggest producers of renewable power in the globe. And here they aim, so they have that integrated strategy approach. So they want to be in the generation of power with a lot of green power, but not only. So they also invest in CCGTs. They invest also in batteries. And of course, they also want to be in the supply of power to big corporates that have deep pockets and that want to pay a premium for having 24/7 power, mostly renewable, but not only because the wind doesn't blow every time. On the scope 1 and 2 absolute emissions, they score pretty well, and that's all about methane. So now we have technology to detect methane and to actually make it economical viable and yeah, to sell that methane. So it makes economic sense for an energy company to tackle methane emissions. And therefore we see that Total Energy faces the decarbonization on a smart way, and while still ensuring returns for shareholders. Now, maybe as a conclusion, I hope that you've seen that at DPAM we move much beyond pure SBTI tracking. We follow from very close our companies we invest in order to ensure that they execute the transition in a manner that is good for the climate, but also for shareholders. Thank you for your attention.
Thank you so much, Lorenzo. Now, there are some roving mics. There should be people with mics in the audience around. Does anybody have any questions? So, lady at the back and then here. So, yeah.
Hello, thank you so much. It was very interesting. Can you just please provide a quick overview on when Scope 4 emissions were determined and the complexity that you have for measuring and tracking Scope 4 emissions with your customers?
So for the moment, it's mostly about discussion with the companies. Some of them, they to avoid greenwashing, they don't disclose Scope 4. So it's more in the informal discussion we have with the companies.
Okay.
But we take that into account ourselves.
Can you
And I think, probably that the market will move to include Scope 4, maybe not in the short term, but hopefully in the medium term.
Yes. What is the proper definition of a Scope 4 emission?
So Scope 4, Scope 4 emissions are the negative emissions that a company generates. So meaning that with their process, they capture CO2, basically.
Thank you.
Okay, and then the gentleman here, sweetie, if you want to come in the blue shirt.
Well, thanks for your great insight. Just have a small question, or maybe your assessment. How possible is it that we actually continue the way we're continuing with renewable energies? As you know, there's lots of investments, we produce a lot of energy nowadays, but now we start to get to the barrier of the infrastructure of energy transition. Where lots of, especially as you said, the steel companies, they want to switch to fully electric ovens. How accessible will this be in the future, as the networks themselves will be quite over capacity and these take a longer time to adjust?
Yeah, well, when you look at the growth of grid companies, it's tremendous. It's for some grid companies in Germany, it's 20% CAGR to 2030. So they are investing massively in the grids to cater for that demand of that renewable power will deliver. So it's about. I mean, you maybe in the past it was more about purely renewable power, and then we realized that we didn't have that our networks were not fit for that. So we now invest in networks, and we also invest more in batteries as a way to smoothen a little bit the flexibility of generation in renewables. That's something that the US has been doing for some time, and we are as often late in the game, but that is happening also in Europe.
Thank you.
Okay, brilliant. Well, thank you very much, Lorenzo. Thank you for coming.
Thank you.